What's up, everybody? Welcome to Risky Ryan Trades. What a crazy week. And man, oh man, did my portfolio get clobbered. Magnificent 7 was just crushing it until it wasn't. So, obviously the inflation report came out. It was cool. Everybody thinks we're going to get a rate cut in September, 85% chance. And what no one saw coming was all the profit taking of all the major institutions from the big names that have been successful so far, like NVDA, like Meta, etc. And they rotated into names that have been beaten up and hurt in this high rate environment. And I'm sure we all know that the Russell 2000 is roaring right now, back to life. But I thought that we might take a closer look at what the heck is going on and where the money is going. So if you find value in this video at any point, why don't you go ahead and hit that like button. And quick disclaimer, this is not financial advice, entertainment purposes only. If you lose money trading, that's on you. Make sure that you use wise investment and trading habits that are sustainable in the long run. And I just hope this is my opinion and the things that I'm seeing, and I hope that you find value in it. So let's dive right into it. What we're looking at right now is the S&P 500 versus the equal weighted S&P 500. You have the S&P 500 in black and the equal weighted in blue. The ticker symbol for the equal weighted is RSP, and this goes all the way back to 2015. And as you can see, for 1, 2, 3, 4, nearly 5 years, the equal weighted has traded pretty much right alongside the S&P 500. But then after the crash for COVID in 2020, let's go ahead. Well, geez, even then, after the crash, it traded alongside it. It even did a little bit better at the end of 2021. But after it peaked, here, let's just get this a little bit smaller here. Okay, so at the bottom of the 2022 October trough, after all the euphoria in 2021, equal weighted traded alongside the S&P 500. But then during the pullback that we experienced in March, you can see a major divergence. Now, this was the Magnificent 7 pushing the stock market up. All the big, large cap growth names were pushing forward. And during this time, inflation was in question. We thought everything was good to go, and then, oh geez, are we going to get rate cuts? What's going to happen? And you had this pullback. There's other reasons for the pullback, but that was happening around this time. And the major names recovered, but all the rest of the stock market failed to recover. Now, let's fast forward to 5 days ago. July 11th comes out, or July 11th happens, and CPI report comes out, and the rest of the market rallies, and they sell off the big names. So the equal weighted is now starting to pull ahead a little bit, or at least catch up. And it looks like this bull market is starting to broaden now that rate cuts are on the horizon. Now, let's take a look here. We're going to zoom out a little bit. So this is the S&P 500 versus the Nasdaq in pink versus small caps, IWM, Russell 2000 in red, and mid caps in orange. You can see, Nasdaq's always outperformed for that period of time. Mid caps, small caps were moving alongside, and then they never recovered after COVID. Well, I shouldn't say that. They roared in 2021. You see that? But then after that, the Russell's been on cool down, mid caps have been sort of keeping up, and the Nasdaq, has fully recovered. We're going to go to the bottom of that, like right here. So right here was when we weren't sure if rate cuts were happening anytime soon, and the Russell just died along with the mid caps. Nasdaq did just fine, and then we go to the 5-day, and you can see a major divergence happen. So a major change happened. You see the Russell roaring, mid caps roaring, S&P 500 dipping, Nasdaq dipping more. What we're looking at here is all of the major ETFs. So you could see since, here, let's go back 5 years real quick. So XLK, technology in red, huge overperformer. XHB, home builders, really, always solid, it looks like. Financials kind of trade alongside the S&P 500 for most of this. And, holding up the bottom, you've got utilities, you've got, what's orange? Financials are in orange. Sorry, I misspoke. XLY is consumer discretionary. That did really well into 2021, but now it's kind of, inflation hurt consumers, no doubt about it. Let's just get a little closer instead of looking at ancient history here. So let's go to the bottom. And once the market started to recover here, so since the recovery in 2023, energy at the bottom, it did have its moment because of inflation, but it seems to be cooling off along with inflation. You've got, in deep blue, you got utilities, which are starting to make up for lost time. It looks like they're moving quite well. In green, you have basic materials, and so on and so forth. Now, let's take a look at, the bottom in April here and how things have done. Holding up the bottom, once again, energy. You can see over here, home builders lately is really starting to pop. You've got consumer discretionary starting to move forward, catching up to the S&P. You had utilities were alongside tech, and then they kind of sunk. But now they're starting to come back. And of course you have tech crushing it, right? But now let's look at what happened after the after the CPI report. You've got tech and consumer discretionary taking a dip, and everything else moving up. Here's the rotation. Consumer discretionary was looking strong up until this point. However, the thing about the rate cuts is once we get them, that means that the consumer is struggling. People are struggling. The economy's cooling off. People aren't spending money on discretionary things, hence consumer discretionary. Home builders, holy mackerel. And then everything else kind of going alongside. Home builders, keep your eye on home builders. They are clearly one of the favorites based on that CPI report that came out. Now let's look at the Russell 2000. This is here, let's go to a 5-year chart. Actually, let's go to a 10-year chart. So Russell 2000 in black, and then two of the major components of the Russell 2000 are going to be biotech and regional banks. You have biotech in orange, and biotech almost always seems to do good. However, now they're right back down to the returns that you would have gotten had you just invested in the Russell all that long time ago. So, which is unusual. It's a disparity. You may expect this to pull away again. So I've got my eye on biotech. You also see the regional banks. They had a very hard time in this, like the rate environment, when we knew, oh God, the rates are not going to go down anytime soon. So let's go to the 2-year, and I want to go to the bottom in October. And you can see the regional banks did great, and then they fell off a cliff, and then and along with the Russell. And biotech kind of held up for the most part. Now it's, the regional banks traded alongside because they've been holding down that index. Let's go to April, the bottom of April. You can see basically trading alongside of it, actually got under it, and now since July 1st, we see both starting to take off. And if we go to the 5-day, you can see KRE, regional banks, are popping. And actually, let's just I want to put KRE in here, and let's look at tech. XLK. Couldn't be clear. Oh, couldn't be clearer. If you go back 3 years, tech just crushes it, right? Always crushes it. Until just now. Big change about 5 days ago. So there has been a major rotation out of the big tech names into these areas of the economy, because we are in a bull cycle, and it's going to last another year or two, as long as the economy doesn't cool down too much, which if we start lowering interest rates again, we could get that soft landing. It looks like that is in the cards. Now, what happens if you're like me and you invest in big tech, you like big tech? Well, let's take a look and see how big tech is doing, the Magnificent Seven. Obviously, NVIDIA in green here, absolutely crushing it. Meta had an amazing recovery, followed by Amazon. Then you have Google and Microsoft. And below that, you have Apple and Tesla. Those are doing the worst since year to date. However, we go to 3 months, and you see Apple is catching up. Apple's catching up. Tesla is catching up. 3-month returns, Tesla's right there with NVIDIA. And you have Meta at the very bottom, alongside Amazon and Microsoft. Microsoft's been pretty steady. Now, let's take a look at the 5-day. And we're going to look right here. And you can see Tesla got dumped. My theory on this, I don't think the Tesla trade is over this year, and I think that Tesla will have a really good year and a half ahead of it. However, so let me back it up. They're clearly rotating out of names like Meta and NVIDIA, to a degree NVIDIA, because they've had such a strong recovery. Can they really have a great second half compared to some of these other names? Tesla, I think they want to invest in, but they had such an incredible run. They got their money back. It was year to date. They got their money back. It went on a crazy skyrocket, move over the last little while. And they just took their gains, rotated out, and stuck it into these new plays that they wanted to do. And also, Tesla announced that they're going to push the robotaxi announcement further along. I think he knows that earnings are not going to be beautiful. It's going to take the stock back to reality, and their hype announcement is not going to move the needle. And I think he wants to move it, after the summer, after the stock price stabilizes a little bit more. So I don't think the Tesla trade is quite here yet, in my opinion, but as far as Tesla goes, I've always been kind of wrong about Tesla. I'm probably not the best guy to listen to when it comes to that. However, I am objective. I'm not like this crazy like Tesla cult member, so I'm just showing you what I'm seeing here. I mean, the numbers speak for themselves. Apple, strongest. Apple survived this whole thing and outperformed the S&P 500 since this big dip. It's the only one that's actually held up. So I think that Apple, they don't want to be caught underweight on Apple, because it could have an amazing second half. And I think that's what they think. And I think that they know that next year they're going to have a great return on that as well. So they're not selling their Apple shares like they're selling their Meta shares, like they're selling their NVIDIA shares, which is the second lowest. And then, the other guys, they kind of treated them the same, you can see. Going forward, what I am doing, I like utilities because they're a defensive play. They're also performing really well. I don't really want to chase the Russell 2000 right now, especially if we get, between now and the rate cut, we could get another CPI print that shows that the economy is cooling off really bad, and now those small caps aren't going to have any profits. So yeah, they get the rate cuts, but no economy, no growth. And small caps need growth. So utilities to me is a really safe place to park my money and, potentially get some, outsized returns over the summer. Also, going into earnings season, which is next week, I want to have protections on. I'm a little risk off right now. I don't want to hold too much of my big tech names going through earnings, because I believe that I'm going to get an opportunity to pick up one of those names at bargain pricing, at the bottom of the dumpster where someone left it. So right now, I actually have anywhere from 10 to 20% of my retirement account or my IRA is sitting in cash waiting to buy something that falls out of the sky over earnings season. And we've had just an amazing first half. There's always like a Santa Claus rally, right before the beginning of the year, the fourth quarter. So I just find it more prudent to trim my winnings and wait to see if I can pick up a name I've been meaning to grab a hold of. I also, I'm not chasing the small caps, but I have a little bit of money in a mid-cap ETF, mid-cap growth. So that's where I have my money, at least today. Next week, it could be in a totally different spot, but going into these earnings, I'm fine missing out on a major move. I'd much rather try to pick up a name that I've been meaning to pick up, or add to current positions that I'm hodling. There's certain positions like Costco and CrowdStrike that I have a full position on, and they're getting pummeled, and I may double down if I get like a really good price on them. So anyways, I hope this was informative. I hope you enjoyed it. If you did, please would you hit the like button? It helps the algorithm. If you want me to take a look and compare some other stocks or sectors, or put another thing in the bar chart and give you my opinion, that kind of thing, leave a comment below, or just leave a comment below, tell me good job. That's great too. Helps the algorithm. And if you've enjoyed more than one of my videos and you've come back a few times and you're not subscribed, would you consider being a subscriber? It would really help me out. Anyways, good luck next week. It should be a bit of a roller coaster. So be smart, be smart, be wise, but it's okay to be a little risky. All right, Risky Ryan out. Thank you so much.